Hello, everyone, and thanks very much for joining us. My name is Paul Sanger, and I'm your host for today's session. The topic for today is the global end-to-end supply chain for batteries, lithium, and EVs, and how can Australian investors get access to this global investment thematic. The format is a presentation followed by Q&A. Please, and I encourage you, please feel free to enter your questions for our guest presenters into the Q&A box at the bottom of your screen as we progress. Please ensure to put your name on the question, because we don't have time to ask the question. We can have our presenters answer your question via email after the event. Our presenters today are two Blairs, Blair Hannon and Blair Kirkhope. Blair Hannon is Head of Investment Strategy at Global X ETFs. Blair is an experienced financial services professional with over 15 years experience across investment management, high net worth advice, distribution, and presenting, with a focus on equities, fixed income, passive and active funds, and alternatives. Welcome, Blair Hannon.
Yeah, Blair I hope I'm Blair number one, not Blair number two.
Yeah, Blair number one. Blair Kirkhope is Head of Sequoia Specialist Investments. Blair is an experienced financial markets professional with a strong tax background, covering 11 years of front office experience in the investment banking sector, specializing in equity, commodity derivatives, structured investment solutions, portfolio risk management solutions, and equity finance. Our presenters will discuss two investment opportunities currently allowing investors to get access to a broadly diversified international portfolio of stocks, providing access to the broader global end-to-end battery supply chain. Without further ado, I'd like to hand over to Blair Hannon to begin the presentation. Blair, welcome, and over to you.
Yeah, I'd prefer to be referred to Blair number one from now on, if you can. Thank you very much. Look, really appreciate obviously Sequoia letting us have a chat about this, and in context, with obviously the participants that are viewing today, this is something we talk about quite a bit. Understandably, something that's very important, I think, to Australia, but outside of pure lithium, which I think most of Australians certainly dive into, it is probably a little bit. It's a bit of a bigger game that is across a multiple supply chain. So maybe if we could pass to the next slide, which is always our favorite slide, which is the disclaimer. Once that comes up, we can probably skip to that one to the third slide as well. It was important just to know, nothing we say in this is going to be considered any type of advice. If it's obviously very general in nature, we're not taking into consideration your personal circumstances. So we'll push through. So just a quick one on who Global X is, for those of you who don't know. We are a truly global fund manager. We are owned by a conglomerate out of Korea called Miro. I was actually lucky enough to be up in Korea a couple of weeks ago at our global ETF rally. And as you can see there, we're across certainly the US, by far our biggest part of our market. But you've got Hong Kong, you've got Japan, we've got Latin America and Europe as well. So yeah, we are truly global. And what do? We specialize across a range of different areas. And one of those is certainly thematics, which we're going to talk about today. And the other two that are maybe not so relevant, but one is income and income type investing. And the third one is commodities, which is a kind of, we're getting a little bit to there on this one, with obviously the name being lithium. So look, it's certainly something that we have both here in Australia, and for those of you who are been been investing for a while, been in the industry, what it might be, would know that we previously were called ETF Securities, and been around for quite a long time in Australia. We've just ticked over our anniversary for so again, talking about commodities, gold. So our gold fund is now 20 years old. That's obviously investing in direct gold in a vault in London through an ETF structure. I'm not going to spend time on that today, but just to know, we've been around for a long time here in Australia. But yes, we are now Global X. Maybe the next slide. So what we talk about, and we're going to do this very quickly, but what we talk about is when we think about thematic investing as a broader subset of a style of investing, when you think about, obviously active, certainly plays a role in a portfolio, whether that's your stock picking yourself, whether that's you're allocating to an active manager to stock pick on your behalf. Absolutely no issue with that. I think there is certainly a lot of value there. The second part of it is obviously broader passive investing. Now, think about broad passive core allocation of a portfolio. Most of that is going to be in geographical based index style investing, like a ASX 200 or S&P 500 or even a NASDAQ, which has a slight tech bent, but or MSCI World for a real broad one. So that's where I think a lot of investors gravitate towards, and it makes sense to do that. When you think about thematic investing, though, and this is why I think ETFs are actually great for this style of investing, they are much more specific, they're much more targeted, and on the back of that, obviously more niche, but you're trying to allocate to possibly a subsector, but really, and we're calling it a theme, that's going to be able to play out. And we're talking a lot at the moment, we're talking about lithium and battery technology today, but things like AI as a potential allocation. How do you play that on a subset of companies that may be allocating to AI? But the 3 points we want to make on it is you need to be, or when we're bringing products to market, or when you're investing in products, it's the same. Essentially, it's the same thing. You need these 3 things. You need to be highly convicted that it's not just a fad, that it is truly, change, like big paradigm shift, changes in demographics, changes in technology, behavior, political regulation, these sorts of things. That's going to make us more convicted that we have the ability to then have a long-term product that we would invest in. And on the same on your side, you wouldn't invest in something that you're not convicted in yourself. Second one, probably more so for us, and it does play out if you're thinking about this as an investor as well, but the investability. So we can't really say a true theme is playable if you can't have a reasonable amount of companies that have high liquidity, or liquidity enough that you can get access to that broad subset and be able to trade that. An example I use is we do a lot in the decarbonisation space as a thematic, a bunch of different options in that space. One of them that we hear a little bit about, again, won't dive into the detail of it, is something like carbon capture. Now, you probably can't play that. If you think that's a theme, it's probably not a theme, it's more as part of a theme. But if you want to play that specifically, it's hard. There's not a lot of direct companies doing that at this point. There's some parts of bigger companies doing it with smaller exposure. But that's kind of the thing. You need to have an amount of investable companies, usually equities. You can't really do it through bonds, but an amount of companies that you can then package together, put in an ETF, then you get exposure to that theme. And then lastly, as you would expect, we need this to be long-term. We need this to be a period of time that is not going to be, as I mentioned earlier, a fad. The hard part is you don't know at the time necessarily what is a fad and what isn't. So, when we look at some of these, we just recently, this lithium's been out for this LIT out of the US has been out for 13 years. You look at ACDC in Australia, that's been out for around 6 years. So these are certainly, we've been playing this theme for quite a while. We just recently brought out a copper ETF that just, investing in copper, which again, decarbonisation. We utilized our US fund, which has been out for 10 years as well. So we don't want to just bring out things that are fad at this point in time. So that's important. Again, I think that's just a construct. We can move on past that. Maybe the next slide. When we think about thematics, though, this is, and we won't hone in on every single one of these, but this is something that we really, really talk to a lot, is the context of when you think about business cycles as we see them now, they're obviously cyclical. And, we're talking about inflation goes up, interest rates go up, pushes inflation down, interest rates go down. It's reasonably cyclical. That same thing can be said across a range of types of businesses, whether you allocate to defensives and then move into growth or value, whatever it might be. When you think about technologies in general, we utilize what's called the S-curve. We didn't make up the S-curve. I think it came out of Harvard many years ago. This is around technological adoption. So this is not to say that you need to invest on the left and get to the right. Nothing to do with that. This is just around where we see thematics where they have listed in the US or listed in Australia, where we think that the levels of adoption they are, and then what part of the curve they're moving up to. So whether you invest on the far left, and hydrogen's one we have a lot of conversations about, because we do have a hydrogen fund here in Oz. It is very far left because if you think about green hydrogen, specifically green hydrogen, and how that's being used as part of a fuel cell structure, well, that's very early days still. The technology is getting built out. It probably isn't economical at this point. If you look at something on the far right, like social media, Meta's a great example. It is essentially ex-growth. They either bolt on things like, which they've done probably most recently, not sure whether WhatsApp or Instagram was most recent, but a couple of years ago, but they're ex-growth. So they're having to reinvent themselves. And they obviously tried to go back to the start of this curve with the metaverse. Again, probably hasn't really worked out. They're now sort of pivoting towards more AI. Obviously, the area that we're going to be focused on today is lithium battery tech. If you can't see what that is, it's kind of just on the right at the start of the early adopters phase. And this is kind of the sweet spot for our technology. It means that some of those bugs or some of those issues of that early technology have been ironed out. Some of those innovators are now starting to move into that. They said, okay, this is actually good technology. This works. We're going to now start to get more towards, not mass market, that's early majority, but towards opening the door to more companies to play in this space. And we're certainly seeing that when you think about not lithium and battery tech necessarily, but certainly electric vehicles, which is the story everything to this story anyway, which is certainly the driver of what is lithium battery tech. If you don't have EVs, it kind of falls away. So again, this is just a framework. We like this framework. I think it's useful for, we speak to a lot of advisors about this, speak to a lot of direct investors about this as just a generalized idea that this might work for you if you want to look at this as a solution to think about where I want to play on this curve. So maybe next slide, please. Okay, so let's dive into lithium. Look, we're going to sort of present. The idea here isn't to speak about necessarily specific companies, to give you balance sheet analysis. We're an ETF business. So when we think about the analysis of this, we think about high level, top down, and how to present this as an investment thesis that then you invest in a broader theme. Because if you are obviously going to be doing direct investments in single stocks, well, look, this is obviously important and remains important because this is the top down, but the bottom up of doing balance sheet assessment, especially obviously in lithium, looking at drill results, understanding feasibility studies, that's not going to be the area that we're going to focus on today, because it's again valuable, but this is much more around those who want to understand why we still think lithium as part of a battery technology and push into electric vehicles is really important. So look, as we know, if you remember back in sort of 2015, lithium had a bit of a spurt. It started to think it was off, and part of that was on the back of is when EVs, with the expectation that EVs was going to take off, and it didn't really happen. And it comes down to the fact that we were just a little bit early in that phase, and the core of that is what is lithium for? Anyone who's been investing in this space would know. Sort of earlier 2010, the use case wasn't that great because the amount that you needed to allocate from a battery technology point of view, whether it was a smartphone, whether it was a tablet, a laptop, wasn't significant. In comparison to the amount that you need for an electric vehicle, which is obviously very, very significant, you're in a situation where it's an absolute step change in driving forward what you're actually requiring from a lithium point of view. I think the second part of it is, and I got to go to an S&P Global conference. We've got some really good content on lithium at the moment if you want to deep dive into that space. And talking to, when you think about the nickel componentry of whether it's nickel cadmium or whatever type of battery technology you want to play, lithium still remains is obviously a core part of it, as you can see on that chart. It's not the major part, but it is the driver of the conductivity in the battery and the retention. So it's very vital. And continues to remain so across whether it's an LFP or a nickel-driven battery. It is vital that lithium plays a role and continues to play a role in that battery technology. Some of you might have had a look into sodium batteries at the moment, sodium ion. Look, it's certainly, from my understanding of it, certainly early days for sodium. And the problem for sodium a little bit is obviously doesn't have the range, doesn't have the conductivity. Doesn't go on fire though, which is certainly a positive. But they are trying to work that out in a general sense. But when we think about the infrastructure that's getting built around the battery technology, certainly it is still pushing down the lithium route. Maybe the next slide, please, Blair. So going back to this point, this whole thesis around lithium does, and as part of a battery technology and then EVs is just really driven around demand of electric vehicles. So this is at the back end of, this is last year. We need to update this chart, but I think you don't really need to know because it just stands true of what it is. So I'll draw your attention to a couple of things. The first being those top countries that are currently miles ahead of everyone else in terms of EV penetration. They are the Nordics. They certainly are. They're very beneficial of a lot of green energy in their own right, whether it's hydro or other areas. And then the regulations that drove a real uptake into EVs. So again, miles ahead. Then I'll draw your attention to the bottom, and this is it's a little bit embarrassing for us because Australia at the bottom of this chart, and it hasn't really improved. And look, we've had some regulations come in recently through the Labor government, Chris Bowen, and they're still a little bit they're a bit hacksaw. They're not really going to drive huge change. Look, all it's really going to do is slow down slightly on the side of emissions, but not really push people too far down the path of EVs. So when you look at this chart, where has the big changes moved? Well, certainly the Nordics was driven by regulation and the combination of use case. Secondly, Europe. Now we know Europe's headlong into their absolute move to electric vehicles. 2035 is broadly for Europe the last time you're going to get an internal combustion engine sold. An interesting stat is, and this is across the fleet, so they can kind of get around this a little bit, but by 2028, they actually essentially can't sell a car in Europe that has a petrol per litre emission of over 4 litres. So what that means is per 100, right? So what that means is you have to have a subset of EVs in your fleet to broaden that out to give you exposure. Otherwise, anyone knows if you've got a car now, it's not going to get under 4 litres per 100 kilometres of fuel. So it's absolutely driving towards that. So Europe's definitely there. The US is getting better. We know that they are certainly spending a lot of infrastructure. We can talk about the specifics as well, but areas like Tesla opening up to Ford and now GM for their charging infrastructure is huge. That opens the door. Again, Australia doesn't have any of that. But the one that really matters without question is China. This is what's going to drive absolute outcomes for definitely for lithium and just in general for battery technology, because the weight of people, certainly. Where does battery technology getting made? Unequivocally, in China, it is by far the dominant maker of battery technology and the leader of technology. Certainly some of it playing a role in areas like South Korea as well. But China is out there. And, what you hear on the back of China is one, regulations are driving that. So that's obviously a massive tailwind. Two, the use case, China's obviously got a lot of traffic of being in a quiet car, being in a situation where that car is much more, and BYD is obviously very, very does very well up there, as does Tesla. That you're getting these situations where the consumer is driving that change. And the second big part of it about this, and maybe I'm getting ahead of myself with the slides here, but is a thing called price parity on EVs versus industrial internal combustion engines. In China, it's very close. It's not there yet, but it's very close. Where in something like Australia, if you want to compare a Model 3 Tesla to a similar sized car, talking about a Mazda 3, it's nearly 100% more. So this is what's going to, again, we're still my point is kind of where we go back to that S-curve. We're still in the early days here. We are early days. We're not necessarily on the track. If you look at that broad chart, where our adoption rates, we certainly haven't kicked off any way too far. Maybe the next slide. Hopefully it's I've got to remember my slides in order. Yeah, so this is certainly what we talk to a lot. I think it's a really interesting concept here. Apologize for the amount of words and information on here, but there's a couple of things to take away. Actually, there's really one thing to take away. There's one thing to take away. At a 5% penetration rate, Australia's sort of around 3%, but a 5% penetration rate, we've generally seen that is a tipping point for industrial combustion engines. Again, you need things like regulation, you need things to drive this, to move into what's going to essentially be the dominant technology moving forward. So in the situation of Norway, it's just a good example because it's one of the largest in the world with 84%. I think it's even more now. As they saw 5% tick over, that acceleration really rose heavily. And we're seeing that, and this is the important part. So that's great. That's a bit backward looking. The important part is we're seeing that in China. So we're seeing in China that the acceleration from when it tipped over 5% to then moving to 16 is so rapid when then hence the expectation is that you're going to see massive amounts of CAGR growth in that space in the next sort of 3 to 5 years. And technology is helping that, obviously. Again, regulations is helping that, price is helping that. So this is really, where we struggle in Australia because there's some really big roadblocks. But when we see this as a bit of a test case for someone like China and a little bit to the US as well. Next slide, please. So this is really talking about when we think about the whole supply chain. So if we stick to the far left, we've certainly got a situation where we've got lithium being the core component. We know in Australia it's all about hard rock. We know obviously there's a bunch of companies that I'm sure you've invested in that are specific in that space. The middle of this supply chain is obviously battery technology. You mentioned that a little bit earlier. Where do we play? You play in China, you play in South Korea. And the far right of this is either electric vehicle manufacturers or in the case of original equipment manufacturers, so Mercedes-Benz, Volkswagen, Ford, obviously BMW, and this is where this is the driver of what's going to be happening and why something like lithium in general is going to be in demand going forward. Because if there wasn't any demand from the car manufacturers, which obviously has flow on, supply demand through it going through from the consumer, then this whole thesis falls over pretty quickly. So the movements that are happening of these larger companies, and you'd see this anecdotally just around the traps, if you're looking at advertisements, if you're looking at buying a car, whatever it might be, the drivers here is massive. So I think one of the best examples is Ford. Ford, who have their largest selling car in the US is the F-150. It's a truck the size of this room. It's massive. They are bringing it to Australia incidentally this year, I believe. They obviously brought out the Lightning version, which I heard on a good podcast, that you're essentially getting one of the lowest cost batteries because of the size of the battery. You can power your house for 3 days. The F-150 battery, which is pretty amazing. But they have such demand. So they are starting to deliver those models, but they had such demand that even though in the back of last year they were raising the price, the demand was still going up. Obviously, lithium's come off a little bit, slightly rebounded, but that obviously flowed through, as you would expect, throughput for these consumers. So there's such strong demand around moving to an electric future in some of these spaces. And again, I'm not necessarily, I don't drive an electric vehicle in Australia. I don't think many of us would. But the expectation was that you could get one at the same price and have infrastructure that you build into. I think the choice for a lot of people will be probably moving towards an EV as an option as well. But again, you're going to have that choice because every car brand is going to have an availability there that you can utilize. Next slide, please. So this is talking a little bit about the lithium. This is our expectations. Everyone knows, I think, whether you did economics, and I think the Sequoia guys mentioned earlier, you did hear some benchmark minerals recently as well. So this might have slightly changed since this was issued, but the expectations are that we are still going to be the deficit's got less, but we are still going to be in a deficit of lithium just due to the speed of execution, whether it's in the South American brine or in the hard rock in Australia. The speed of execution to get it out of the ground, to get it up to China, to get it processed, to get it into battery technology. And you're sort of seeing that a little bit with the difference between hydroxide and carbonate prices, and they're obviously moving around. We've had a really good rebound, but it's been a tough back end of 2022 and 2023. But it probably ran a bit ahead of itself in terms of the lithium price, and has now regulated itself back to, I wouldn't say equilibrium, but whether you believe it's still an elevated level, making a call on the level of the price, but certainly back to a level that is probably more sustainable for a battery manufacturer and then an EV producer to utilize. But the point is here, the long-term nature of this, pairing the two things, really strong consumer demand on EVs and then supply getting better, no question getting better, but still going to be in deficit is a good combination from an investment thesis. Next slide, please. And this just talks to the fact that it does start to somewhat equalize. Again, this is from a bunch of different sources. We try to take things from different areas, but whether that's SQM, we've heard recently around nationalization up in Chile, whether that's Albemarle, Ganfeng, that they're all driving, and obviously the Australian companies, but they're all driving towards opening up that supply at a reasonable price to be able to supply these battery manufacturers. But yeah, the expectation is that we are finding, and this is my point earlier, closer to what is likely an equilibrium of, this is in this case is hydroxide, not carbonate, but hydroxide prices going forward. It's certainly possible spikes and moves depending on what happens with supply, but it's getting closer to, it's again, not a mature market, but getting closer to an understanding between, if we think about many years ago in BHP and Rio de Iron Ore with contract pricing, certainly there's no benchmark pricing here. That doesn't work out perfectly, but you're getting closer to a bit of an equilibrium there as well. Next slide, please. So we're getting pretty close to the end here, and then we can sort of talk a little bit more about this particular fund and the options here. But this is to the point around that S-curve. This is where we think lithium is in terms of the broader subset of, whether you want to call them disruptive metals, green metals, whatever it is, the push on decarbonisation is massive. It is still very much in its early days. If you're a believer in things like copper driving the electricity around the world now, whether from a grid or from an electric vehicle, that's obviously going to be really important. Whether that's the other types of materials going into battery technology, cobalt, nickel, obviously core of that is lithium. Whether that's at the far end, which is technically not a renewable, but uranium, obviously. We're not playing a huge role there, but globally, that's certainly really important. So this is the context, but we still think we're in reasonably early days for lithium. If you think about, again, how far lithium's got back, and we've been talking a lot about copper again too. This copper has been used for millennia to drive different types of structuring around, moving, whether it's electricity, whether it might be whatever the use case or an infrastructure was utilized. Lithium really is in its early days, because obviously battery technology is in its early days, but it's moving very, very fast, which is obviously really important. So maybe move on to the next slide, which could be getting close to the end here. Yeah, so I think the context here is this. So this is a US-based ETF. Yes, we're Global X Australia, but this is a US-based ETF. And for those of you who do know ACDC, it's slightly different, more focus on the materials. ACDC is actually quite bit lower on the materials. It's around 15%, whereas this is broader on the materials. So I think this is the context, and this is certainly why someone like Sequoia is looking at this as an option to play more in that lithium space, because you are getting more exposure. Still in some areas with the consumer discretionary, some of these companies fall into that, like Tesla, BYD, and Rivian. But I think you can look there and think about, well, what are you getting? Sort of 40 or so stocks that are focused on this space, currently 41, but it sort of gravitates around 40. A real focus on not uncapping. There's a cap in the methodology. Remember, this is an ETF, right? We're not picking stocks here. This is an ETF that is very much a rules-based structure. And look, that's the important part. We talked about this earlier around ETFs being a really good solution for this, because it's a rules-based structure. You can go and have a look. You can go onto our, in particular for this fund, our US website, have a look at the index methodology, and that's what we're going to follow. That's our job, to follow that index. So you get likes of obviously things like Albemarle playing in that space. That's going to be driving on the lithium side. But yeah, 43% lithium. But then you get the other areas, the battery technology around Panasonic, TDK. Talked about Tesla, BYD, Samsung. Rivian's another one, obviously, that's listed recently. LG. So you're getting a good mix of both materials. You're getting some EVs, and you're getting some battery technology, which is the whole point of how you want to play a theme. Otherwise, because if you just bought lithium, lithium's not a theme, it's a commodity. So you're thinking about how you're playing this theme. So I don't know, is that Paul Blair, I don't know, that hopefully that gave a bit of context around one, the investment thesis, why we think this still stacks up, even though it's been around for a while, and two, a little bit about the product at a high level, just to show that, this is reasonably well thought out, and how to find out more as well.
Thanks, Blair. Yeah, that was very, very informative. Just picking up on some of the things that you highlighted there, and you emphasised a couple of times that the thematic is very much in the early stages, early days. Some of the charts you use to support that, the take up of EVs. You mentioned legislation across the globe, forcing the change from petrol cars, diesel cars to EVs. And the other thing you mentioned at the beginning is having a thematic that is long term in nature. And we had Benchmark Minerals on here a couple of weeks ago that clearly showed a bunch of charts that this is only the start of the uptake and the demand for lithium and other critical components. So maybe just if you could just emphasize again that having that long-term thematic, it really is playing to the pathway of investing via ETFs. Maybe you could just elaborate a bit more on that. That'd be great.
Well, I think this is the context. I think, and again, we kind of using AI as an example right now. I know we're not just sort of welcoming here a little bit, but the question's always going to be, and you never 100% know now, but this is where, whether it's utilizing us for a bit of content and research insights, obviously doing your own research and understanding where you play out, but it's putting those pieces together. And AI is an example where people go, well, is this going to come? Is it going to go? Is it going to be just a nothing thing? Where, our expectation on that would be, it's like the change from PC to mobile. That was a massive shift and big investment opportunity. This is something similar. So you think the same can be said of something that's been structured as, we've used internal combustion engines since Ford, I can't remember the date that they invented the car. This is a gigantic shift in terms of where we're moving, and that we're not really talking here around autonomous vehicles. There was a headline this morning I saw just popped up on my screen on Bloomberg saying one of the, take this as a grain of salt, but one of the unknowns in this case is robo taxis could be a big game changer here. So there's that whole bunch of information where, if you are thinking about what autonomous vehicles will be, they'll essentially only be electric vehicles. And that's, again, the component of thinking long-term. This is the long-term nature of your thinking that needs to be important around investing in thematics. So like us as an ETF provider, what we're going to do is we're going to make sure we think that there's value in providing these solutions to investors, whether that's here in Oz or whether that's in the US or Europe, whatever it might be. That doesn't mean that, there's always going to be, in a life cycle of an ETF, a period of time when then prices are depressed, whether that's, again, business cycle pushing that down, whatever it might be, that may provide you an opportunity to buy. But we always continue to think that this has value in the long term. But, you look at AI, again, to come back to that, are you willing to buy NVIDIA or that space at a PE of 186 times, even with the expectation the earnings starts to get better in the early year? So this is the investor's conundrum of like, when's the right time to invest? And we're not going to solve that for you, but we want to make sure that the solution that we still think is going to be long-term, and then, gives the opportunity for investors with the content and research we generate that shows them, the reason why we think it's going to continue to stack up.
Yeah, that's great. And look, a question here. Can you please explain how Australian investors can get access to LIT?
So I guess you've got a couple of options. You can obviously, if you like lit in its own sense, and you like the more materials focus, again, if you want to get exposure to, we know Albemarle's now looking at Liontown here in Oz, so there might be a dual listing, like kind of like what Block did with Afterpay. Don't know that. Don't quote me on that. But that's a possibility. You can obviously then, to get access to offshore companies, without doubt, ETFs are probably the most simple way outside of going and buying it offshore. So if you want to do that, obviously ACDC is a version. It's not exactly the same. It's probably more focused on electric vehicles. It's much higher. It's a less exposure to materials mentioned earlier. So if you do like lit listed in the US, again, depending on who you broke through, many brokers now, whether they're an advised broker or a direct to investor broker, have opened the door to international investing and make it much simpler, which is huge, because those pipes have remained blocked for such a long time. So the fact that that's been opened. So if you do want to, obviously lit US is available to buy, which again, up to you how you want to play it out. We're just obviously giving you a couple of options if that's the best way.
Yeah, that's great. And look, the lit is listed in the US, I presume in US dollars.
Yes.
Does this represent a sort of currency risk for Australian investors? Is that something they should be thinking about?
Yeah, look, any investment into an international company is going to have a level of currency risk. And look, for equities, as a general rule, that's okay. You're kind of exposed to that because the driver is going to be in the US, is whether it's US dollars, whether in some of these companies, because they're their home currency is not going to be all US dollars, but yes, you're going to be buying in US dollars. So you have to understand that that's going to have to be a conversion at the particular point in time to buy it. Any distributions that come back are going to have to go through. You might have to do WFN form. Again, your broker might be able to help with that. Obviously, in Australia, most ETFs don't do that. But yes, that is it. That is an understanding. But no, this is a global fund. So the underlying, companies are trading in much different currencies, but the actual fund is trading in US. You're right.
That's good. Blair 1, look, really appreciate it. Thanks for your presentation. There's a bunch of questions come through. I'll save those to the end after Blair 2 has finished his presentation. So Blair 2, over to you.
Okay. Thanks very much, Paul. And thank you, Blair 1 for that presentation. And what we wanted to do today, so I represent Sequoia Specialist Investments, and what we really wanted to discuss was really a second option for investors to consider to get access to this global end-to-end supply chain thematic that Blair number 1's just been presenting extremely well. So our thinking here is that there are two ways. If investors looking to allocate part of their portfolio to a fully funded investment into LIT or even ACDC through the ASX, that's fine. But what we realize and what we note with a number of investors is that not too many are too keen to sacrifice too much income from their portfolio or too much capital growth potential from their existing portfolio. So what we at Sequoia like to do is bring low cost access through limited recourse lending solutions to enable investors to get access to a thematic at a very low cost, thereby not requiring as much of a portfolio allocation in order to get that exposure, and to do so in a way which is tax efficient and also eligible for SMSF. So that's what we're trying to do here. Investors have the option to go fully funded with Global X, or if they're looking for something which is lower cost but benefits from limited recourse lending, which I'll discuss in this presentation, then our product that we're offering under Global Lithium Series 2, which closes on the 26th of June, so it's a short period, is the second option. So I'll talk through that. Just a quick disclaimer. So anything that we discuss here is going to be on a general advice basis only, and does not, of course, take into account anyone's personal circumstances. So who are we as Sequoia Specialist Investments? So we've been around since 2010. We look at ourselves as one of the leading issuers of structured investments in the Australian marketplace. We've issued over 120 investments over the last 12 or 13 years, and raising 500 to 600 million cumulative leverage notional during that period of time. Our main aim here really is to offer innovative investment solutions, enabling clients to get access to investment thematics that may be difficult to get access to either through the ASX or through international platforms, and offer that in a cost-efficient and tax-efficient manner for Australian investors. And so, for example, if you don't have international execution available through your stockbroker and you would like access to LIT, then this is an alternative way to get access, albeit it would be in a 100% geared format. So on to the next slide. So why are we actually considering to offer that right now? So we at Sequoia do spend a lot of time looking at timing. So if we are looking to offer something in a leverage format, we think taking advantage of a particular entry point opportunity is important. You want to be looking at trying to take advantage of pullbacks in price. And so when you look at, in line with the rest of the global market, when you look at the lit price, it reached a sort of a high going into 2021. It's pulled back quite significantly and quite nicely into the beginning of this year, and starting to show signs of stabilization in conjunction with global markets generally. I would say global equity markets, I should say. So we like that as an entry point. We also think that the actual sell-off in the global lithium price itself, since the end of last year going into sort of the April lows, was quite a brutal, almost a 70% sell-off, and that was, I think, more or less in response to the China curbing some of the subsidies that they were making available to EVs. And I think that in itself is showing, as Blair H discussed, was starting to show signs of getting closer to the equilibrium point in terms of price. And we think that is presenting a nice opportunity as well. If anything, there's probably a little bit of upside there. We know that a number of analysts, including Benchmark Mineral Intelligence and also Morgan Stanley, have sort of started to indicate that they think that the structure of the market is becoming more positive in terms of the lithium price, and looking at, again, in terms of the deficits as well. In terms of that, there's a lot of research to show that the forecasting in terms of deficit in terms of lithium is expected to continue at least for the next few years. So the number of factors on the lithium supply side, and then just the global equity market structure itself, we think cyclically is indicating that we're getting close to a turning point. You can see that with in the tech space, the equity markets in the US have really started to stabilize. So a lot of the stuff that we look at in terms of cyclical analysis is showing that stabilization this year, going higher into 2024, potentially 25. So we think that as a whole is presenting a nice opportunity for investors to consider a leveraged exposure to this thematic. And this is just showing you what's actually happened to the global. So this is LIT, this is the Global X Lithium ETF that's listed in the US. We can see, the sort of pullback that we've seen since the end of 2021 going into the sort of beginning of this year, and just showing the first sort of signs of stabilization, I would say. And we like this as an entry point right now. We think it's just taking advantage of the pullback over the last sort of 18 months or so. And then when just looking at some of the outlook in terms of the lithium price and the deficit, so those bar charts are looking more indicating the deficits. There are different graphs, more or less indicating the same thing, that deficits expected going into the next few years. And that line chart's more looking at the price, and on the right hand side is sort of that hovering above. The expectation is going to hover above that sort of $40 a kilo sort of price, is sort of the general expectation that we think. And I think at the moment we're roughly about 47 or 48 roughly on average, is what I've been sort of seeing. So we think it's sort of that's starting to shape up nicely after the pullback in price that we saw. It's not shown in this chart, but there was a big I think it was $80 roughly a kilo towards the end of last year. It's pulled back to about 47. So we think it's sort of a nice point in terms of lithium price, which is going to support the market going forward. So let's talk about why now. Let's talk about the actual investment that we're offering. So this is Global Lithium Series 2. So this is a 2-year investment term where Sequoia, we would lend investors 100% of the investment amount for a full 2-year period. So there's no initial margin involved. 100% of the investment amount we lend on a limited recourse basis. I'll talk a bit to that a little bit later in terms of what that actually means. The interest rate that we're charging there is 9.15%. So maybe on a mortgage these days you're paying close to 6%. So it's an extra 3.15% in order for us to lend 100% and also on a limited recourse basis per annum. The application fee of 1.65%. And then so the total cost is 9.15% times 2 years, plus the 1.65% would equate to a total investment cost for the 2-year period of 19.95%. So just as an example there, if you wanted $100,000 of exposure to the Global X Lithium and Battery Tech ETF, so that's the one that's listed in the US, if you wanted $100,000 of exposure for 2 years, that would cost you $19,950. And then at maturity, what happens in terms of the return, what we do is we calculate the end of the 2-year period, what has been the performance of that ETF during that 2-year period, and apply it to in that example, the $100,000 investment amount. So if we just talk through one example, if it was up 30% after 2 years, after taking into account a number of the other factors involved, including the hurdle. So if we look at the performance, that would be a coupon of $30,000 coming back, and I'll talk through that in more detail in the slides following. So what are the benefits of the 100% limited recourse loan? So what we're doing is we're lending 100% of the investment amount. The coupon that's payable at maturity is based on the fund's performance during that term, during the 2-year term, applied to the 100% investment amount. So you're really benefiting from 100% geared on the upside. But in terms of the downside risk, in the event that the ETF actually goes down during that period, then you're not actually exposed. You don't actually have to repay any part of the loan at maturity in the event that the ETF actually goes down in performance. So you're not exposed in relation to the loan amount. You can never lose more than the total upfront cost. So your maximum risk of loss in relation to this investment is $19,950 in the example of $100,000. So we like the fact that you're capping your worst case scenario in that situation, and you have no cap on the upside. So you get all the upside on the $100,000 of investment exposure, but with no risk beyond the $19,950 in relation to that example. One other point: there's just no margining, no initial margins. There's no impact in terms of credit scoring, etc. And this is eligible for SMSF. So just talking through to the underlying. So this product actually does reference lit to make it very clear. So the reason we're doing it on lit versus ACDC for two reasons is for liquidity reasons. When we offer this kind of leverage structure, we need as much liquidity as we can in order to be able to provide it on a limited recourse basis, the lending on a limited recourse basis. And we do like the higher material exposure here. So yeah, I won't talk too much to that. I think Blair gave a very good explanation of the ETF itself, but for more details are included in the PDS. Again, top 10 holdings. Look, we like the fact that it includes the largest and biggest names in this investment thematic globally. Look, a lot of investors will have, a lot of you will have exposure to maybe a lot of the local names in Australia. We like the fact that it's the big, large cap, the biggest names in the world in terms of whether it be lithium mining or production or in the batteries or EVs. So we like that, and that's why we're offering it. In terms of the sector and geographical breakdown, again, this is what we think is a very nicely diversified exposure to the investment thematic, both in terms of country exposure and also in relation to the sector exposure. We think there's roughly about 40 stocks are included. So it's a nice diversified portfolio that you can get access to through one investment at a cost of only 19.95% for that 2 years. So let's talk about how we pay the performance at maturity. So this is what we do at maturity. So we calculate the performance of the ETF throughout the 2-year investment term. And then what we do is we deduct what is first called a 10% hurdle, and also take into account monthly averaging. So what we think, I'll talk a little bit about that first. So in terms of the hurdle, so in order for us to come to market at a price of less than 20% for 2 years, we needed to include a 10% hurdle. So in order for clients to basically break even on this investment, what it means is that the fund itself, adjusted for currency movements, needs to be up at least 29.95%. So you add that 10%. So the original investment cost was 19.95%, but the fund needs to be up 29.95% adjusted for currency at maturity, at least for investors to get the money back. And then after that, the return on cash starts to become a lot higher. And I'll go through a few examples there. We also include 3 months of averaging during the first 3 months. We like that just simply because we think on a cyclical basis, the markets, especially in the US, have had a bit of a rally over the last few months. And what we're looking at, there's a chance that you could get a bit of a pullback into sort of September or August, September. So we think by including some averaging within this structure, you could take advantage of a bit of a pullback during that period. So that's why that's included. And finally, if they're at maturity, we do take into account currency changes that can have an impact on the amount of the performance coupon at maturity. It's fairly marginal from that point of view. There is no currency risk in relation to the loan amount, so there's no risk from that perspective. So let's talk through a few hypothetical scenarios here in terms of the performance coupon that could be paid at maturity. So we talked those first 3 examples there would be in the case where the client would, or an investor would effectively be generating a loss. So in the event that, it's a worst case, not worst case, but let's say the ETF really just crashes 50%, then in that case, you're walking away for the loan. You've lost your 19,950. That's your cost. That's your worst case loss there. If we talk through an example, let's say the fund is up 10%, still in that particular case, there's a 100% loss. In that particular case, you lost 19,950. In the event that it's up 30%, then clients would be generating effectively a break-even point, just above break-even in this particular example. And then finally, once you start getting above that 30%, then you start generating a pretty high level of return on cash flow from that perspective. So if we're up, up at that 50%, in that case, you'll be receiving a sort of a coupon of $43,000 on this $100,000 example. So you're more than doubling your money at that point. Once you're up at that sort of 50% sort of level, then you're looking to sort of double your cash outlay. And that's really what we're hoping that we can achieve through this investment. Of course, there's no particular forecast, but that's, if we start to retest the prior highs that were reached towards the end of 2021, we sort of break through there before maturity, then you'll be looking at a very high level of return. But again, your worst case loss here is the 9,950 in the event that the ETF goes down. Okay, so let's talk again about the break-even point. Just wanted to re-emphasize this. Because of the existence of the hurdle, the 10% hurdle, the fund needs to be up at least 29.95% at maturity once adjusted for currency in order for clients to at least break even. So keep that in mind. You need to have the expectation that would occur during the next 2 years. And so we're looking for investors who are very bullish on this thematic of the next 2 years, really take advantage of this pullback in price that we've seen over the last year and a half, as I said before. This walks through a couple of examples here. 4 examples talking about, 4 hypothetical examples talking about the performance of the fund or the ETF over the 2-year period. So in this case, the green line here is looking at the first scenario, very, very bullish example here, of course. And here in this particular case, we're saying, let's assume that the fund is up, adjusted for currency, 63.26% after deducting the hurdle. Then the performance coupon of maturity would be 63,250. Alternatively, in the worst case scenario there, if it goes down and we're below the hurdle, then it's going to be a 100% loss of 19,950. Okay, talking through just a few examples of the upfront cost. So the minimum investment size here is 9,975. So that would provide investors with $50,000 of investment exposure for the 2-year period. In the case that I've been giving through the presentation, if it was $100,000 of investment exposure, it would be costing 19,950. Or if it's $200,000 of investment, for example, it would be 39,900. So there's no limit here in terms of size. Just to say that the minimum here is at 9,975. And so that's it for me in terms of risks. Just to reiterate here that this is really a high risk investment with the potential to generate a high return. That's the main takeaway here in terms of risk. For more details, please refer to the PDS. And then finally, in terms of the target market here. So if there are any retail investors here are listening to the webcast, it's important to note that in order to invest into our product, it needs to fall within the target market. So what that means is that you need to be looking for capital growth. You need to be looking at something which, and understand this is a high risk, high return investment, where you're really only looking to allocate a very small part of your portfolio. For more details, please refer to your financial advisor. And finally, this is closing on the 26th of June and trading on the 30th of June. So we're receiving applications up until the 26th. And then what we do is we run direct debits across clients' bank accounts during the week leading into 30 June, with the investment starting on the 30th of June. So that's it from me, Paul.
Yeah, thanks very much. Got a few questions. The last couple of years, we've seen some pretty big wild swings in lithium stocks, both on the upside and on the downside. So I've got a bull and bear market sort of questions for you. So just remind us, what happens if the lit goes on a really strong run? Can clients get out early and take profits before maturity?
Okay, that's a good question. Yeah, so in the event that good scenario, bullish scenario, in the event that lit really does take off and gets above that hurdle and you're starting to trade into a pretty good range there before maturity, then clients actually can get out at any point before maturity. So there's no lock-in or anything like that. We do provide daily liquidity in terms of investors if they wish to take profits before maturity. So yes, we do provide liquidity before maturity.
Okay, and let's go on the sort of the bear scenario, and maybe use the pullback in lithium that we saw towards the end of 21 and 22. Lithium came back, and stocks actually took a bit of a battering. And I'm pretty sure I heard you say this. Can you just confirm? Is there any risk at all that investors need to repay the loan amount if the LIP falls and is down by the maturity date?
Yeah. So yes, no, good question. So just to confirm that for sure, absolutely, that the maximum risk that clients will take in this investment is a total upfront cost of 19.95%. So in no circumstance whatsoever will clients be exposed to more than that. We have no recourse in terms of any personal assets or whatsoever in relation to this investment. The reason we're able to do that is because included within the interest rate, there is included an embedded cost of protection.
Yeah.
And that's part of the reason why it's above the cost of what you would normally pay for a mortgage, is because we do include an embedded cost of protection. So we certainly don't take risk on our side either. This is our hedge provider on this particular investment is the one that takes the risk in relation to the loan amount. So that's the reason why.
Yeah, that's great. And there was a couple of questions that came through to talking about entry point and taking away the thematic of lithium demand over the next 10, 15 years. But there's an unforeseen crisis, the GFC, God forbid, global war, that can affect the market. You don't, you lose.
Oh, yeah, well, absolutely. I mean, of course, we can't absolutely forecast the future price. We think for us, it's about a risk reward equation, and we think if you're looking at the way that the general global equity market itself is shaping up, our general view on global markets here at Sequoia is that we're seeing a massive bear market unfold in the bond markets particularly, and there's a lot of capital that's moving away from bond markets into equity markets, and that's a big reason why you're seeing global equity markets being underpinned. There's been a lot of bearish commentary across global analysts for a long, long time, but if you just look at the strength, especially in the US, the strength of equity markets globally, we're only 10% from all-time highs in terms of 10 to 15% from all-time highs in the US. A big part of the reason for that is because there's a big shift of capital away from the bond markets, especially the government bond markets, into equities, and that feeds into these kind of equity thematics, and that's part of the reason why we do have a bullish outlook ourselves on this. And if anything, if there is if something does unfold in terms of international war, we think again one of the places where that capital could end up residing is actually in the equity market. You might get a bit of a shock to the downside, but if you're in Europe, I don't think if something was to unfold in that part of the world, I don't think you necessarily want to be owning government debt. I think equities are, in the US or other parts of the world which are more removed from that can act as an interesting place for people to park capital, and that's certainly the way that we're looking at things at the moment.
That's great, Blair. And look, just one final question for Blair. Maybe you got some comments on this. There's a attendee asking, is there any risk of the sort of easy mineral lithium running out? What are the global deposits? Have you got any comments on that? Any facts you can share with us?
Look, again, if you go back to the context, and look, I think the question is understandable because we're talking about supply, deficit, these sorts of things. It actually isn't overly rare commodity. So no, it probably isn't anything. Certainly not in the short term. Any risk of it running out. It's about cost. It's about cost of getting it out of the ground. So obviously finding it, getting out of the ground, making sure based on a feasibility study that cost analysis stacks up, and then having obviously customer output contracts that you work with obviously through China. I think there's obviously there's a couple of ways. One through hard rock and spodumene, and the other one through the brine. Both of them are reasonably abundant. The risks aren't so much on supply, it's around regulation. And we talked about this very, very briefly earlier, but if you don't know, areas that are looking to, like some of these South American countries, looking to nationalize their lithium deposits, and there was a bit of pressure on Albemarle and SQM on the back of that, because it's actually not so bad for them. They've got a very strong agreement in place, but makes it hard to then put a lot of capital in to find more, then not be able to get the full return. So that's probably the greater risk rather than broad supply, I would think. But what that does is that again somewhat restrains supply in terms of full capital output by companies. which then obviously the demand isn't going back. So what is the third lever in the supply and demand program? It's just price. So if you get any further restraint on supply, the expectation is that price would go up.
Yeah, and probably another thing that I'll just throw in there is that talking about getting these new projects online cost money, and you've seen obviously over the last sort of year or so the Inflation Reduction Act in the US, where the US are throwing money into projects to help them in that transition to coming up, and the Critical Mineral Act in Europe as well, trying to make it easier and help fund these projects, and permitting and those sort of things can hopefully can be sped up, so more supply can come on. But it all comes down to getting funding for those projects. So
look, there's no question. I think that's a great point. I think the governments the developed nation governments are certainly moving down the path of trying to help. Critical minerals is a great example, as is the Inflation Act. I think the other side of it is, though, we're in a higher interest rate environment, as we heard Blair Kay talk about, obviously impacting the amount of the capital that needs to be allocated around interest rates. That means the cost of capital to raise money to do this mining is more expensive in comparison to 2 or 3 years ago. So again, that's an input that they need. As a capex return you would need as a miner needs to be significantly higher. So again, that's going to help make sure. And I think this is an area that we're looking at closely in the uranium space, where they need to get it to a certain equilibrium before it actually has value as a miner. So okay, good point. There's both sides getting pulled, I think, in that space.
Yeah. And look, just a final comment from myself to everyone who's online today. Following this presentation, Share Cafe will be sending out an email to all attendees with links to both investments after this webinar. So you will get more details of both the products that will come through to your emails. And on that, I'd like to thank both Blairs for very informative presentations. Thanks for your time today, and thank you to the audience for tuning in. It's much appreciated. So to everybody, have a great afternoon.